All right, we are going to be diving into lower time frame order flow and be looking at entries as well. Now, this is everything that we are going to be diving into. So context area, time frame alignment, confirmation, scenarios to watch out for, risk management, and at last we have homework as well. So number one, context area. It is very and crucial to understand that the better the higher time frame context area, the better the lower time frame order flow. So essentially saying that the better the higher time frame order flow, the easier lower time frame order flow will be to trade as well. The hard work is always done on the higher time frame. You can't compensate a good lower time frame with a bad higher time frame. So it's very important to understand and to do yourself a favor. If you want to start looking at good, easy to read lower time frame order flow, then start looking at good, easy to read higher time frame context areas. Now, when I look at a trade ID, and I would advise for you to do the same, when I look at someone sends me a loss, for example, and I start looking at the trade ID, what they might have done wrong, quote unquote, then I start looking not at the lower time frame. The lower time frame can be very clean, but like I mentioned, a good lower time frame will not be able to compensate for a bad higher time frame. So I always look, what is the higher time frame context area? Is the higher time frame order flow actually looking good? If that's not the case, then the lower time frame can be as beautiful as it may be, but it just won't work out, or at least the probability of it working out is very low. I would rather have an extremely good higher time frame context area and a very ugly lower time frame order flow and then still enter and capitalize on it than having a very ugly higher time frame context area and beautiful lower time frame order flow, because that simply most of the time won't play out, because the institutions move from institutional higher time frame levels to institutional higher time frame levels. So everything is based on the higher time frame. Very important to emphasize on this fact. So what are we then looking at? Again, it's, for example, this context area right there, daily fair value gap towards daily swing high right there, moving from institutional higher time frame levels to institutional higher time frame levels, like we've been discussing in the previous videos. So here, this will translate over to, for example, a 15-minute market maker model. This is exactly what we are going to dive into in this video. Now, I want you to understand, like mentioned in previous videos as well, I don't necessarily say market maker model. And that's because it doesn't have to be that complicated, and it doesn't have to have all those different levels of a market maker model. If you understand order flow, you understand those context areas, you understand a market maker model. So you and a lot of traders in the MMT understand a market maker model, whilst we have never named it a market maker model. And that's important to understand, because then we simplify it and we take away a layer of focus. And that allows us to have more focus, more energy to focus on our psychology, to focus on things that are truly necessary. So here we have that fair value gap at swing high. And this is what we will look at on the lower time frame right there, how we can capitalize and look for entries right there as well. Okay, then time frame alignment right here. So first of all, we are going to go over the thought process behind time frame alignment. So the reason why we want to have everything in context, and when we make sure that the higher time frame context area is also in context, so of all the other time frames that we are dealing with, then we know we can't have, or most likely we will not have, a further retracement. So what I mean by that is, if we have a daily bullish fair value gap and it is above a monthly bullish fair value gap, then we still have a reason to retrace, potentially towards the monthly fair value gap, to then continue higher. But if that's not the case, and we only have a daily bullish fair value gap, that's most likely, if we are going to continue higher, that's the furthest it can retrace. Now, of course, depends on the fair value area, etc. But that's, in theory, the furthest it can retrace right there before we continue higher. So that means once we have a sting into that daily fair value gap, you can compare it to, it's like a clean slate. At that moment in time, you start from zero. So you might even be able to go into the 1 minute time frame, etc., because price action has nothing to return to anymore. It's from that level, it's going to continue higher right there, or at least create a rejection. So that allows us to go into certain time frames to capitalize on it. because there's no reason to retrace anymore at that moment in time. Now, what that looks like, etc., all things we're going to dive into. I just want you to understand the simple thought process behind time frame alignment. Now, it's important to understand as well, because I mentioned a daily value gap, for example, a 1 minute entry. Now, that in general, you should avoid. It's not the greatest, because the closer the context time frame and entry time frame are to one another, the less confirmation you are going to need. So if we're talking from a 2-candle rejection standpoint, why is that possible? For example, with a daily value gap, with the daily time frame entry confirmation and a 4-hour 2-candle rejection confirmation, because those time frames are very close to each other. But if you say the opposite, and we need, for example, a daily value gap as our context time frame, and we then have a 1 minute as our entry time frame, we are going to need a lot of fair value gaps in our favor to actually get a proper confirmation. So we need to be able to find a balance right there. Now, if you're entering on candle signs and you're entering on a 4-hour 2-candle rejection from a daily fair value gap, what does that mean? It essentially means that you're entering with fair value gaps that have been created on the lower time frame. So that is what candle signs is based on. So that is then where we have to find a balance for order flow entry and for order flow confirmation as well. Now, this is the balance that we want to use right here. For the order flow entries and for our quote unquote normal entries, this is my preferred time frame alignment when we're talking about order flow entries. And for example, next video, what we'll dive into is Delirium, a trading plan. This is my preferred time frame alignment. Again, it comes down to as well a little bit of a personal preference, but it's important to understand that that what I have here, the time frame alignment, it allows us to have more detail when we go into a little bit of lower time frame as well. Now, right here, this is our baseline. So everything that requires an order flow entry, this is our minimum. And what I mean by that is monthly, we go to the 4-hour for an order flow entry. And the 4-hour is the minimum right there. So a monthly to a 1-hour, don't do that. You would not want to pay attention to that right there, unless it's under very specific circumstances, but you don't want to do that right there. It's the same for the weekly to the 1-hour. Now you can do order flow entries on the monthly, then to the daily, or the weekly to the 4-hour. That's perfectly fine, but don't go below that right there. So the time frame alignment we have monthly to 4-hour, weekly to 1-hour, daily to 50 minutes, 4-hour to 5 minutes, 1-hour to 1 minute, 50 minutes to 1 minute. On the left, these are our context time frames. On the right, we have our entry time frames right there. But if we're talking about the monthly to the 4-hour, that 4-hour can also be again used as a context time frame to go into the 5 minutes right there. So that's where you can get very creative. Now, let's move this towards the left right there. And let's put a line in between it, because this is for order flow entries, for an ST plus RE, as we like to call it. An ST plus RE is essentially what I refer to as an order flow entry right there. It's the normal entry that I personally prefer to use. Then you also have ST entries, so sharp turn entries. Now, for sharp turn entries, you can use less confirmation essentially, because the time frames are aligned differently as well. So for example, for the monthly, you can go into the daily, weekly, 4-hour, daily, 1-hour, 4-hour, 50 minute, 1-hour, 5 minutes, and the 50 minute, the 1 minute right there. Now, I need you to understand that just because ST entries, they look beautiful, they are quite beautiful as well, they are not necessarily the best entries. And especially if you're just starting out, when you're struggling to find high probability or low probability conditions, it is very important to understand that ST entries are not necessarily always the best. Because ST plus RE entries, in my opinion, and why I prefer them, is because they give you a lot more clarity on what's actually happening on that time frame, if the price action on that time frame actually is good, and we can actually look to enter as well. Very important. So it's an extra layer of confirmation in that case, ST plus RE. Now, right here, confirmations for an ST plus RE. So for an order flow entry. Number one, it's just an objective step-by-step process essentially. Number one, we start with a context area. So determine the time frame of that context area. The number two, we have an ST. So we have a sharp turn out of the context area. Then number 3, we retrace back into any PD array created in the ST order flow lag. So when you have a sharp turn, it has also an order flow lag, of course, coming out of our context area. That order flow lag, once we create a retracement into either the fair value gap, the fair value area, or sometimes even, and there's rare scenarios where it might even be the swing high or the swing low, and then we create a new order flow lag. So number 4, the second order flow lag created in the same direction coming from the previous ST order flow lag, that is the re. Now a re is the following. We enter on the re right there, the second order flow lag. A re simply stands for a re-entry. So that's how it was created essentially, where the ST is a potential first entry opportunity. A re is another entry. So it's the second entry opportunity right there that makes it a re-entry. So let's take a look at a chart example of what this essentially looks like. All right, right here we are on Canadian dollar CHF, and I first want to dive into the context areas that we are using for this example. Here on the monthly, we have this monthly fair value gap sitting right there, which we could potentially continue lower from. Now, if we dive into the daily right here, we actually see that we already got a daily fair value gap itself to continue lower from it. Now, this in itself, we could argue could be a sharp turn entry, right? Now, I don't want to enter from this sharp turn entry right there on the daily time frame. I want to confirm this through, so confirm this extra. On the 4 hour, what do we have? On the 4 hour, we see that we have this 4 hour fair value gap from the daily fair value gap as well. This, again, is also in itself already a sharp turn entry, right? But again, depending on your personal preference, and what I would advise as well is stick to certain time frames. So yes, we have monthly, weekly, daily, 4 hour, 1 hour, 50 minute, 5 minute, and the 1 minute time frame right there. But stick to certain time frames that you want to use consistently. And what I mean by that is stick to, okay, I would always like to see 15 minute or 5 minute entries, for example, in the beginning. So essentially always using 4 hour and daily context time frames right there at first. Then switching from 5 minutes to, for example, 5 minute entries, and then next week you do 4 hour entries. That's not the same thing, because now you're completely changing your trading. It might be the same trading plan and it might come down to the same thing, but you're going from a day trader to all of a sudden a swing trader right there. So stick to the same criteria right there. Very important. So at least stick to either lower time frame or higher time frame entries. Okay. So let's say from the 4 hour, I'm also not interested right there in entry. Then we can go down from that 4 hour to the 5 minute right there to look for an ST plus re from this 4 hour fair value gap right here. Now we see that we create fair value gaps coming back into the overall 4 hour fair value gap right there, even a little bit higher right here. This is where the order flow transition that we have talked about comes into play. So we ideally want to see a fair value gap coming into the 4 hour fair value gap right there, and a fair value gap continuing lower right there. They don't have to be overlapping. There's different layers of an ST. So you have a beautiful ST, a very good ST, you have a mid ST, and you have a very ugly sharp turn. The most important part is, for a sharp turn, is not necessarily religiously sticking to the fact, well, Ario said we need to have a clear fair value gap in and a clear fair value gap out, and they need to be overlapping right there. That's not the thought process behind an ST, a sharp turn. The thought process behind a sharp turn is that we create a reversal and it happens quite fast. So a sharp turn is not a consolidating turn, which is important to understand. So I'll show a few examples of that in a little bit as well. But when people have a sharp turn and they have a fair value gap in and a fair value gap out, and in the meantime, it might be consolidating all this time, then this, just because it has a fair value gap in and a fair value gap out, is not a sharp turn. It's a bulky turn. It's a consolidation turn. It's not sharp. A sharp turn is all based on the fact that we are tricking people into the market right there with bullish fair value gaps, and then we have the real move, bearish fair value gaps right there, which happens very fast to trap that liquidity. That's the thought process behind a sharp turn. Okay, so here, what do we want to see? We want to see a retracement back into this ST order flow lag, ideally, to see a premium array holding and create a new order flow leg to continue lower right there. So essentially, take the order flow leg right there that we created from the sharp turn. So essentially the first order flow leg right here. Then mark it out, see if we create a retracement into any premium rate that we have in that leg. So we have a fair value gap, we have this fair value area, and we have this swing high right there. Create a retracement, create a new order flow leg. Does not happen in this case. In this case, it doesn't really matter that does not happen, but it does matter for your overall confirmation. So what I mean by that is you just repeat the steps. You wait for this order flow leg right there to get traded back into, and now you wait again for a new order flow leg to continue lower right there. So the overall confirmation just moves further a little bit right there. Now, the reason why this is, and the thought process behind the sharp turn and the rewrite there and why that is important, is because I want visual evidence that premium arrays, in this case, when we're looking at a bearish entry, is holding. So premium arrays should be holding right there, and there should be visual evidence of premium arrays holding. If we're talking about a bullish entry, we should have visual evidence of discount arrays holding. So when we have a fair value gap, or this fair value area right there, and we have visual evidence right there that it is actually holding, and we do continue lower right there, and we create a new order flow leg, for example, right there, then that is our re, and that right there could be our entry right there. Now, in an ST plus re, what do you want to cover? This is something that we're going to dive into specifically as well in trading plan videos right there, but you do not have to cover at all times the swing high right there. As a general rule of thumb, you cover that right there. You cover the swing high, you cover the last line of defense essentially of the order flow leg. When you start getting more advanced, start refining your stop loss a little bit more. Because in this example, we have a fair value area sitting right there. We have that fair value gap as well. I do not even want to see it retrace in the first place all the way back towards that level right there. Otherwise, for me, it's just low probability conditions. So what we mentioned as well, the furthest the order flow leg can retrace in previous videos is the fair value gap and the overlapping part with that fair value area. So oftentimes you can refine it to the bodies right there and not necessarily the wick. Now this is quite crucial because, for example, right here, you get a 1 to 2 RR before it comes back to break even. If your stop loss was too large right there and you now target a 1 to 2 RR, first of all, you are not day trading anymore. So this 5-minute entry now turns into a 1 hour or a 4 hour entry. So you're not that you're aware of it, you're unaware of the scenario that you are now actually swing trading and not day trading anymore. So that's very important to understand. And as well, it might come back to break even right there to then hit your overall take profit later on, whilst and because you are not refining your stop loss right there. Whilst you could have had a 1 to 2 hour very early on as well. Very important to understand. Now, in this same scenario, when we enter right here from a 5-minute ST plus re, we can do the same thing on the 50-minute, but then it just turns into a sharp turn. Now, do you need to have a 5-minute ST plus re and a 50-minute ST? No, choose one of them, please. Very important as well to understand that when you're trading Delirium or when I'm trading Delirium, for example, I don't look at 5-minute ST plus re and a 50-minute ST, which one is better to enter from. No, I simply stay on my time frame for my entry confirmation. Unless, and only unless, I need to be in context of the time frame above. So for example, this 50-minute sharp turn right there, that 50-minute fair value gap right there, we see that this 5-minute fair value gap is not in context of the 15-minute. So in this case, I would rather enter right there because that's the 50-minute fair value gap that is in context. And then, for example, cover that high. If I'm talking about a 5-minute ST plus re-entry, just as an example, where the 5-minute is not in context. But if everything is in context, etc., then just choose one time frame. So predetermine for your trading plan whether you're going from the 4-hour to the 5-minute for 5-minute ST plus re or 15-minute for an ST or even ST plus re if you want to do that. But predetermine those time frames. So please, you should never have to ask the question if you should go and look at the 5 minute or the 50 minute. No, you should already know that from your trading plan. Very important. So let's say our predetermined trading plan tells us we should go into the 50 minute. Then we see right here, we have that fair value gap in, so that momentum going in again. Most importantly, it's just a sharp turn right there, and we get those fair value gaps continuing lower. Now, what you do in a sharp turn entry right here, or in this case, for example, we have this fair value gap right there. That fair value gap does actually not get traded back into, and that actually is a breakaway gap. Now, this can also be applied. This is just a general entry technique. This can also be applied to your ST plus re-entries, where if we create a breakaway gap in our entry, then we understand we don't want to see a retracement back into it. We can still enter right there. We can cover potentially the breakaway gap because we don't want to see a retracement back into it, right? So if we create a new fair value gap, which will be at this area right there, then price should not create a further retracement than this right there to continue lower. So we shouldn't have to cover our stop loss all the way at the highs right there. Very important to understand. Now, we can enter like this when our overall context area allows us right here to target a 1 to 2 RR. And what I mean by that is that within our context area right here, we can target a 1 to 2 RR. So if it was the case where we have a scenario like this, because our stop loss was too big right there, and we couldn't target 1 to 2 RR within our context area, then this, I would say, don't take the entry, wait for a more refined entry. But right here, this is not the case, and you can target within the context area a 1 to 2 R, so it's perfectly fine to enter on the creation of that fair value gap, enter on the creation of the breakaway gap as well. Now, let's say you don't want to enter like that, and you simply wait for a new fair value gap. So right here, what happens? We create this sort of a rejection candle. We could argue it closed below the candle right there, so it's an expansion phase, but it's a rejection right there. That's good. So we can expect a retracement into that fair value gap right there. Now again, how far can we retrace? Well, I wouldn't want to see a deep retracement back into this breakaway gap, so the overall stop loss stays quite similar. You could even refine a little bit more towards that high right there or that low of the candle. So then target again a 1 to 2 RR sitting right there. Now, with something like a 2-candle rejection, you could refine it even more. But that's all things that we're going to dive into in the candle science module after the order flow module as well. Then staying on Canadian dollar CHF, I want to look at a bulky turn. So essentially a sharp turn that at all times you want to avoid. All the other sharp turns, they could be perfectly fine, but this sharp turn you definitely want to avoid. Now they are quite obvious and they are not the most difficult to spot. So on Canadian dollar CHF, eventually we do not continue lower from the daily fair value gap right there. Now we create a rejection, yes, but we don't follow through all the way to continue lower. Perfect. Now eventually we create a deep retracement. We create this 4-hour fair value gap right there, which we might want to continue lower from. Now notice why I'm picking this context area. Because in the first place, this 4-hour context area is not a good 4-hour context area right there. This is important to understand. Now, when you are looking to become a filtering process trader and you want to trade something like Delirium, we'll dive into the specifics of that in the Delirium video as well. I just want to mention it here as well. If you're looking to trade 4-hour context areas, they should always be in alignment with the daily, weekly, and monthly. So what I mean by that, if you just only have 4-hour context, then that is 9 out of 10 times not enough. It needs to be supported by daily, weekly, monthly context. So for example, this 4-hour context right here, that's enough. Why? Because that's coming from a monthly fair value gap. So you could go into the lower time frame right here, into the 5 minute, to also look for an entry right there. Now, for example, this 4-hour context is also enough, because that's coming from monthly and the daily fair value gap. This 4-hour context has now disrespected all the previous context areas right there. It's not supported by anything anymore. It's just a random order flow lag right there. We could even argue it's fake order flow. It's not based on anything. So if we do want to continue lower, we should create new order flow to continue lower again. So this context area in itself is not good. It's not a good context area. So if we then go into something like the 15 minutes, what do we see? Well, technically speaking, we create a fair value gap, quite some momentum going back into the 4-hour fair value gap right there. then afterwards, technically speaking, we also create this fair value gap out of it right there. But is this good confirmation? No. Is it bad confirmation because the fair value gaps are not lining up and things like that? No. The fair value gaps are perfectly fine right there. Well, arguably perfectly fine. But it goes and contradicts the logic that we have of a sharp turn in the first place. And that's important to understand, because a sharp turn is named a sharp turn for a reason. It's not a bulky turn. It's not a consolidating turn. It's there to trap people to immediately continue lower again. It's very similar to the understanding that we have of a sweep versus a run on liquidity. When we sweep liquidity, it's aggressive moves. And that's what we want to see as well with a sharp turn. So for example, when we then sweep these highs right there and then create a sharp turn right there, this is beautiful. And not necessarily because now we have the perfect fair value gaps overlapping right there. No, but it's because it happens very fast right there after sweeping those highs. Fast move higher, fast move lower right there. That's a beautiful sharp turn to continue lower from. All right, here we are on gold. And if we go to the weekly time frame first, then what do we see? We have this weekly higher time frame context area where we can reach this swing high as well. Now, this is a great example because order flow has been bullish, the trend has been bullish, market structure has been bullish as well. So this weekly value gap right there, that's essentially perfect. And on the daily right here, we have this daily value gap, which we can also look to continue higher from, which is also, of course, in perfect alignment. So from this daily value gap, let's say we go into the 1 hour, and on the 1 hour right here, we could look at a sharp turn entry on something like this right there. Now, I need you to understand that at this moment in time, what you can also do, because the fair value area right here is actually above the overall fair value gap. That could also allow you to enter on the fair value area itself to then cover the lows right there. Now, I need you to understand that with entries, we could talk 5 hours about just lower time frame entries and the way you can enter and certain entry techniques, etc. But I want to save that for a different video, because that's not the important part about order flow right here. Because lower time frame order flow, and what makes lower time frame order flow important is the higher time frame order flow. Funny enough. So right here, you have a beautiful sharp turn entry. The way you want to enter from that, be my guest. As long as you understand that the higher time frame context areas right there, those are the ones that are important, because they will tell you whether it's a good entry or whether it's a bad entry in the first place. Now, after we reach this daily context high right there, we also on the 4 hour right here, get this 4 hour context area right there, which gets confirmed even on the 15-minute right here with 15-minute sharp turn, if you want to enter from it right there. And even on the 5-minute right there, we also have a 5-minute ST plus re eventually sitting right there. Now you can enter and capitalize on this, for example, with entering whilst entering on the fair value gap creation. Could enter whilst it's creating a new expansion phase candle right there. A simple ST plus re will do. And eventually, once more experienced, you will see there's a multiple variety and variables of entering in a market as well. As long as you understand that the examples that I'm picking right here are not just any kind of examples. They are really, really high probability, really good higher time frame context areas where we are very certain that price will actually continue in that direction as well. That's the most important part. The lower time frame order flow, again, we'll create a separate video on it about entry techniques, potentially even an entry module, but it's not the most important part. It's all about the higher time frame right there. All right, then from confirmations for an ST plus re, we can also move on to the confirmations for an ST, which we've essentially already gone over. Again, I don't want to rant about it, although I've been ranting and emphasizing on it a lot, but it's super important to understand, because this is arguably the biggest mistake that people make. They think when coming into trading, the entries are the most important, right? Because they directly lead to whether it's a winner or loss. But it's important to understand that indirectly, higher time frame context is the most important, because that indirectly leads it to being a winner or a losing trade as well. Where an entry might feel more direct in is it a winner or a loss, it's not the direct correlation to it being a winner or a losing trade. Very important. So right here, I do want to share a few scenarios to watch out for. And the first one right here is an ugly ST plus re. Now, we have already gone over that ugly ST. So a consolidating sharp turn, where the theory and the logic behind it, it just doesn't work out. So that's what we want to avoid. Then we also have another saying in the MMT, which is quite interesting. It's the bigger the ST, the uglier the re. So that oftentimes looks something like this, where we create an ST and the sharp turn is quite large, it's quite big, and the re has a deep retracement and then creates all these internal order flow lags right there in comparison to the bigger ST lag that we are still in. Now, this just simply shows us that the re right there and the overall price action is not strong enough at that moment in time to push higher. So let me show you an example. Right here on Russell, we have this context area right there, that fair value area. And right here, we create a very large sharp turn on the 1 minute right there. Now, this large sharp turn is followed by, in comparison, a very ugly re. We see the sharp turn is, let's say it's 70 right there, 70 points. Then we have right there, 22 points is the re. So relatively seen, now you don't need to measure every ST and re to perfectly get to the points or the pips or what we're looking at right there. But just the general idea right there is that the ST creates a quite large ST and then creates a very small re, relatively seen to the large ST that we have. That doesn't add up. That doesn't make any sense. So this is a scenario that you want to watch out for, where we create a large ST and the re right there is very ugly, very small. Now, in this case, it still reaches above the high right there. And then afterwards, we create a lot of re's afterwards as well within the overall bigger sharp turn lag right here. This is, again, what an ugly ST plus re looks like and what you would ideally want to avoid. Now, next to that, we also have a scenario to watch out for, which is not in context anymore. So let me show you what this looks like and what I mean by that. Now, right here on silver, we have talked about this for quite some time with the fake order flow lag that we had on the daily time frame right there, where the overall higher time frame objective is still to reach that high, which we have reached as well. Beautiful. So on the 4 hour, we see this 4 hour. We could argue at that moment in time, it's also a breakaway gap, but we do. The reality is we do retrace back into it right there and we get proper confirmation. Now, when you go into the 5 minute time frame right here, you might start looking for a 5 minute ST plus re overall, which is perfect, of course. But the longer it takes to create an ST plus re and the longer it takes before price to continue higher, the more fair value gaps it is also going to create. Due to a simple fact, price and time keeps ticking. So what I mean by that is the more minutes we take, the more likely we're also going to create not only a 5 minute fair value gap, but a 1 hour fair value gap, or even a 4 hour fair value gap. So this leads to, in theory, when we have this context area right here on the 4 hour, we have the 4 hour fair value gap, we have the 4 hour swing high right there. This is our context area. That's where we can see a market maker model. So this is where we can enter on an ST plus a re and plus a re and plus a re and plus a re. So in theory, we have the re and we have the re right there, and we have another re sitting right there as well. So this re is what we can also continue higher from right there. So you can enter on every re afterwards, but the re and the re's that come afterwards, so those re-entries very late, are oftentimes not in context anymore. So what I mean by that is now, by the time, because we have created so many candles and simply time has been ticking as well, we also create 15-minute fair value gaps. We also create 1 hour fair value gaps that we can continue higher from, and we will sting into to then continue higher right there. That's important to understand, that when you are looking to capitalize on an ST plus a re, plus a re, plus a re, and you can simply follow every order flow lag afterwards as well, do not get blindsided by the fact that eventually we will create also a higher time frame fair value gaps that we can retrace back into, making price action right here on this time frame quite unpredictable, quite odd. But on the 1 hour, makes a whole lot of sense because it's just a simple sting into that fair value gap to then continue higher from it as well. All right, then one of the last slides that we need to go over is risk management right here. Now, for risk management, we all want to pay attention to simple order flow. So is the entry still in context, things like that. When there's a new order flow lag below your entry, for example, when you're looking at a bearish trade ID, then you can simply already go break even. Now, this can also be seen through candle signs, which we'll also dive into in the candle signs module after the order flow module. But let's give you an example of this. So looking again at Canadian dollar CHF right here, we have this 4-hour fair value gap right there. Then if we go into the 5 minutes right here and we look at that entry again, you want to go break even. First of all, in this case, we reach the context area right there. So we have this context area. If this was our entry on the ST+RE, then when we reach a context area, we always want to go break even. So when we reach the context target. The reason for that is, again, we might be offloading positions right there. So we might be seeing something like this to continue higher instead. Now, next to that, if we ignore that, go and break even, and we simply look at the order flow lags right here, then as soon as we create fair value gaps and fair value areas below our entry, which oftentimes when it's a good order flow entry happens very fast, you can already go break even. So for example, this new order flow lag right here is below our entry. So simply said, there's no reason at that moment in time to return, unless on the 15-minute time frame right here, on the 1-hour time frame, we have a fair value gap that we could still retrace back into, which in this case, let's see, at that moment in time is not the case. And then we start to continue lower again, and then we create a fair value gap we could potentially retrace back into later on, which we do not do to continue lower. We actually disrespect to continue higher overall. So that's essentially going break even. Very simply said, there's one sentence to it, and that is there still a reason to retrace? If there's not a reason to retrace, you should be going break even. And that's essentially understanding the concepts. So right here, even though lower time frame order flow is not that important, it is still quite a long video. And we have gone over everything that is very important to understand when it comes to lower time frame order flow entries as well. So for homework, start spotting those entries. And again, what is important in those entries is also the higher time frame. So start spotting higher time frame, good context areas, and see how you can potentially enter in as well, or how you could have capitalized on it as well. All right, perfect. Thank you.